Thank you for joining us at xm.com for the Daily Market Comment for Wednesday, November 23rd by Mario Sachikiriakos. I'm Christina Marujas. Investors went on a shopping spree on Tuesday, raising their risk exposure to riskier assets without any clear news catalyst behind the sudden shift in sentiment. The S&P 500 closed at its highest level since mid-September as implied volatility collapsed, with a pullback in the dollar and real yields helping to fuel risk appetite. It is quite striking that implied volatility has declined so dramatically heading into what could be a stormy and illiquid holiday season. Even though every leading economic indicator points to trouble ahead, demand for downside protection has evaporated, which suggests that equity traders are either too complacent or heavily hedged already. There's a sharp contrast between asset classes about what lies ahead. Valuations and earnings estimates in stock markets are still consistent with a soft economic landing, whereas the bond market is saying the plane is more likely to crash land, with the yield curve sinking deeper into inverted territory. One of these markets is mispriced, and it's more likely that stocks will need to adjust to reality as the weakening economic data pulse across the world suggests that avoiding a recession next year would be a miracle. In New Zealand, the Reserve Bank raised interest rates by 75 basis points overnight, bringing the cash rate to 4.25%, while officials noted that they spent a lot of time discussing an even bigger increase of a full percentage point. Baked into the RBNZ's latest economic projections was a recession that's expected to hit early next year, which Governor Orr downplayed as likely to be shallow, stressing that reining in inflation is still the main priority and that interest rates will need to move even higher. The New Zealand dollar rose on the news, although not in a convincing manner. In Europe, the latest batch of business surveys contained both good and bad news. Sadly, the surveys were consistent with the Eurozone economy contracting, but on the bright side, the rate of decline eased from October and inflation is showing signs of cooling. Overall, these surveys lend credence to the narrative that the Eurozone is on the brink of recession, but the downturn won't be as deep as investors feared initially, thanks to the massive decline in energy prices. Hence, while the outlook for the euro has started to improve, the prospect of a trend reversal is still premature and probably a story for next year. Finally, the minutes of the latest Fed meeting will be released at 7 o'clock GMT. The report could be considered outdated, but the market almost always reacts to this release, and a hawkish tone could give the dollar a helping hand. This was a Daily Market Comment here at xm.com.